So we need to move on to the third panel, but before we do that, I wanted to sort of note a couple of things. One is I would encourage everybody to read an article, an op-ed that Senator Rubio published last week in the New York Times. Senator Rubio, we actually invited, we almost had a couple of participants from Senator Rubio's office, and unfortunately it couldn't happen at the last minutes, but just wanted to note that Senator Rubio has got some very interesting ideas that are pertinent to this very discussion, and it's worth paying attention to those. Another quick note, it's really very exciting to see this coming together of people from across the political spectrum here in the United States and across the political spectrum in Europe. And this coming together of people from across the Atlantic community. But I also want to note that the Open Markets Institute and the New Approaches to Economic Challenges Initiative at the OECD, this is just the first, we hope, of a series of conversations. These conversations will be bringing in more additional voices in the days to come. One of the next, we're aiming to bring in voices and concerns from around the world, including from India, from Africa, Latin America, and from China. And just building on a comment by Commissioner Chopra and also by Dr. Osterholm earlier, we must be working with China on these issues, even as we structure our supply chains, as we restructure our industrial systems. We must be working very China. We are all in this together. Smart competition policy, as we have learning today, equals resiliency. Smart competition policy also equals community. It can equal global community. So on that note, we are going to move now to the panel 3. We have 4 terrific systems thinkers. And the point of this next panel is to sort of talk about how we are going to design the systems of tomorrow, the industrial systems, the financial systems, the international political systems, learning from the lessons that we've heard thus far about the failures of our industrial systems, and also the role that competition policy played in setting up the environment for those failures. We have with us Sir Paul Tucker. He is the chair of the Systemic Risk Council. Paul was deputy director at the Bank of England, and he sat on its monetary policy, financial stability, and prudential policy committees. He is a member of the G20 Financial Stability Board. Paul is also a author of Unelected Power, which published in 2018 by Princeton University. Terrific to have Paul with us. Mike Masters is with us. He's an old friend. He is the founder and managing member of Masters Capital Management in Atlanta. Mike is also one of the more important reformers in financial regulation, a real hero. He led the efforts to get better control over the derivatives market during the last financial crisis. Mike's work has been covered on 60 Minutes, CBS News, the BBC, the New York Times, and many other outlets. And in 2010, Mike took his concern about the harmful effects of unregulated markets, and he used that to inspire him to establish Better Markets, which is to promote the transparency, accountability, and oversight in domestic and global capital and commodity markets. We also have another fantastic person with us today, Ganesh Sitaraman. He is a professor of law at Vanderbilt. He is one of America's leading young thinkers on the future structure of political economic systems, both domestically and internationally. Has worked very closely with Senator Elizabeth Warren over the years, but he has also worked with people across the political spectrum. He's a connector. Ganesh is the author of a number of really important books. I'll mention 2, The Great Democracy, which came out recently, and The Crisis of the Middle Class Constitution, which came out about 3 years ago. Great books. And last, we have Doyne Farmer, one of the world's most well-known experts on complex systems, working both as a scientist as an entrepreneur on subjects including chaos theory and complexity. Professor Farmer, he's a professor of mathematics where he is the Director of Complexity Economics at the Institute for New Economic Thinking at the Oxford Martin School. And his current research is on complexity economics, and it focuses on systemic risk in financial markets. And in recent months, he's been working a lot on supply chains. One little note, the chair of our board at Open Markets is an economist named Marcellus Andrews, and I wanted to just note his help in sort of putting this meeting together. Marcellus was the person who connected me to Doyne Farmer, for instance, and Marcellus has been a true friend for many years and a true intellectual partner in this work. So our point today now is to look at what lessons should we learn from the reports on supply chain consolidation. What principles should we apply to the process of creating the regulatory guidelines and philosophies of the next world systems? I just want to note, this is not merely a task of sort of planning for the next pandemic. This is a task of making these systems resilient in a way that allows them to absorb any shock, whether it's an earthquake, whether it's a storm, whether it's a political shock. We need to have systems that stand up all the time, that support our societies. So anyway, we're gonna go first to Mr. Tucker. Paul, are you with us?
Yeah, I'm off mute and my camera is on and I can see myself. Can you see me?
Yes, we can.
Okay, good. This has been absolutely fascinating and I'm very glad to be participating. But I was also glad, Barry, if I may say so, that you mentioned that this should be the kind of concern that is shared across the political spectrum. And I say that because I think that we will achieve less in resilience policy the more it gets bundled up with a package of policies to pursue particular, whether it be conservative agendas or progressive agendas. And the reason I emphasize that is this is the kind of disaster that goes to the very stability and security and safety of our societies. I mean, remember the first political question is how can we ensure the security, stability and safety of our societies and as a basis for cooperation? That's a very Hobbesian point, of course. Our answer to it isn't Hobbesian at all. It's that the degree of coercion that the state applies in maintaining those things has to be acceptable to us as citizens. And the liberal answer to that is not very coercive at all. But the reason I'm saying that is A, that is shared almost across the reasonable political spectrum in our societies as a starting point. And secondly, that this is the kind of crisis that does threaten stability because it threatens the safety of our citizens, as do, as you said, war, earthquakes, sometimes financial crises, sometimes terrorism. And one of the first points I want to make is that it's going to be incredibly important in the coming years to ensure that different parts of the public sector don't focus on pandemic risk to the exclusion of all others. So something that happened in my former world, central banking, on both sides of the Atlantic and on both sides of the English Channel, was that central banks and financial regulators after 9/11 focused on terrorism risk. There were many exercises about terrorism risk, and the number of exercises about pure financial crises went down until there was a financial crisis, after which the number of exercises on terrorism risk and on pandemic risk went down. And we just need to be much more comprehensive, not just in banking, for goodness sake, but across different parts of government on the disasters that we need to prepare for. I want to make remarks under three headings: resilience, dependence, and incentives. On resilience, the first point I'd make is, I think it is, a number of people have implicitly made this point, it is much better to focus on the resilience of different systems than where is the next crisis coming from. One of the things that went wrong in my old field, particularly in the United States, is let's set up bodies that will spot where the next financial crisis is coming from. I never had much truck with that. And actually, the people at the top of the policymaking tree internationally focused much more on making the international system resilient, irrespective of where the next crisis was coming from. And I'm not claiming that we did a brilliant job, but I think the focus was the right kind of focus rather than early warning systems for far away risks. The second thing I would say related to that is it's really important to distinguish between economic activities, particular types of business that have an infrastructural type function, and where that infrastructure is vital to society and to the economy. So one of the speakers mentioned the problems, which I broadly share, represented by Facebook and Google and so on. If Facebook shut tonight, I doubt very much whether that would be I mean, people would be very fed up about it, and some people it would damage some people, there's no doubt about that. It wouldn't be on the same scale as the banking crisis, let alone on the same scale of what we're facing now. In the great scheme of things, it would be an inconvenience. Whereas if certain infrastructure providers in other parts of the economy failed, like if the payment system closes tonight, what little economic activity is left will almost end in a world where people, for understandable reasons, don't want to focus on cash. So identifying which services are vital and which infrastructure providers are vital to the provision of those services. And that's where I think a certain type of competition policy comes in, making sure that our economies are absolutely not dependent upon one or even two providers. The second thing I would say under that is, and this is a point for government, is that in all of the major advanced economy democracies, governments compared with 2 generations ago outsource a lot of services. They rely on outsourced company providers. So they face a problem if those outsourcing companies fail, which happened in the UK a few years ago with a firm I think called Carillion. And my point isn't based on its particular circumstances. What was striking to me about that was that although the British government was largely dependent upon that firm for all sorts of services, there had been almost no provision for what would happen if the firm got into financial distress, even though precisely that policy question had been preoccupying finance ministries and central banks in the banking sphere. So, and the US government is dependent upon all sorts of external service providers, and it should identify the top whatever, and what happens if they fail for whatever reason. How do they get recapitalized? How are services maintained? The third thing I would say under resilience is we have to be alert to when changes in technology shift contingency planning or resilience planning shift something from being best practice to being worst practice. And I will give an example. So after 9/11, it was widely regarded as best practice, a dreadful expression, by the way, but nevertheless one that's widely used, best practice to do real-time backups for all one's IT into physically distant sites. But of course, once cyber warfare arrived, actually real-time backup almost flipped from being best practice to worst practice, because it meant that if the virus got into your main site, it was also likely to get in real time into your backup site. So what counts as resilience depends very much on technology. And we should never forget that the ultimate backup to digital is analog. If we want to be resilient against the internet being switched off, then we should have physical copies of some of the things we need. Two briefer comments, if I may, I'll be very quick, on dependence and incentives. Autarky is not an option. I thought the congressman sounded attracted by the concept of autarky. And yet there are some areas, and actually a pandemic is one of them, where only an international approach can work, because the weakest link is a problem to us all. Similarly, though, we can be overly dependent. And one of the biggest questions that policymakers face is, do we want to be dependent for critical things only on states who we regard as absolutely copper-bottomed allies? Or do we even not want to be dependent upon them? And if we say no, we don't even want to be dependent upon our copper-bottomed allies, that will send a signal that will spill over into all sorts of other fields, including security alliances. On the other hand, if we say, well, we can be overly dependent upon allies, but we cannot be overly dependent upon others, then of course we will be crystallizing the hierarchy of allies and potential enemies that we have, and that may not be avoidable. And so these questions about economic and social resilience are absolutely going to dovetail with security policy in the kind of Pentagon sense and the geopolitical struggles that lie ahead. My suspicion is that a world of roughly concentric circles will in slow motion emerge, not by design, but not by holistic design anyway, but by a set of steps where we conclude that trading with China is a good thing for all sorts of goods and services and a bad thing for others. Finally, on incentives. A lot has been said about the incentives of people in the private sector. We should be sensitive to the incentives of people in the public sector. We are learning in a number of major advanced economy democracies that pandemic was the #1 identified risk, and yet little was done about it. And in my country, there were fewer intensive care unit beds than there were in Germany. And the interesting question there is, for me, was this an instance of moral hazard? That actually people that run the health service had to make cuts, and they chose to make them in intensive care. And I think I would say that that kind of choice needs to be made at political level, not at technocratic level. And finally, the last thing I would say, it hasn't come up at all, is the insurance industry is going to try and well, it will say that its contracts don't cover all sorts of things, and those things that it does cover, it may be unwilling to insure afterwards. Something that happened in the UK about 25 years ago is that the state acts explicitly as insurer of last resort for terrorism, and it may well be that the state has to act as insurer of last resort, not just de facto ex post, but de jure up front for other kinds of risk as well. And what I've tried to do is list things which I think could be candidates where people would agree and develop, whether they were on the progressive or conservative end of politics. Thank you.
Thank you, Paul. And we're going to go next to Mike Masters.
Hey, Barry, and thanks for setting this up with open markets, and happy to talk a little bit. I'm going to talk a little bit about more just markets, capital markets, financial markets. And I thought I would really start off just really talking about sort of the default framework that I think most market participants and many companies as well, whether publicly traded or private, still have. And that is this idea of, I call it the cult of efficiency. And I know some of your other guests have talked about this today, but I think it's really important. And it's really the idea that efficiency is sort of the maximized versus everything else. And if anybody, my comments are not, if anybody's interested in going into this in more detail, if you Google anthropic finance, I wrote a series of papers, a couple of papers a few years ago, right after the period of financial reform during DoddFrank, where I sort of went into this sort of the philosophy behind this idea of maximizing efficiency versus other societal goals. And so if you Google anthropic finance, you can, they'll come up, I think at the top of the page, some of the PBS. But at any rate, if you think about it, if we maximize efficiency, then we're minimizing other societal goals and values. And I'm really talking about with markets, and markets really should be reflective of society as a whole. They shouldn't just be, they're not a deity or something like that. They're an allocation mechanism that we use in society to allow us to transact via price. And this idea that, and some of it's inculcated in the efficient markets hypothesis and other ideas, this market fundamentalism, this idea that they all come back to the idea of maximizing efficiency. And what we really should be doing instead of maximizing efficiency is doing an optimization and having balance in our markets and our market structure. You know, so what some people would say a Pareto Equilibrium, trying to get to a situation where other societal values such as resiliency or transparency or even justice are inculcated in our markets. That would be a much better situation for us all in society and would lead to a more durable and robust and stable capital markets and commodity markets framework than we have today. But I just wanted to address that because I still think even 10 years after the financial crisis, I still think that's sort of the default economic philosophy of a lot of market participants and many in the economics profession. And I feel like that we need to look at that first before we really look at other things. And so what I'd like to now is just talk about some of the ways in which, you know, two examples where, you know, we've had, I think, a success in inculcating this idea of resilience and robustness and durability, for instance, into markets. And one practice that's actually, I think, hurts that and actually contributes to the maximization of efficiency, which is, I think, something we really want to avoid. And then I'll talk about something that we can do in the future that I think would be helpful to bringing out this idea that, you know, society could inculcate other values like resilience into markets. And so the first thing I'll talk about is the success, and really that's DoddFrank. And so with DoddFrank, many of you all are familiar with it. It was passed in 2010, and it really built up capital in the U.S. financial system. And as many of you all may know, I mean, building up capital in the financial system at banks by default means that their returns on capital goes down because you have more capital on the same base of loans, and so your returns almost mathematically go down. And so many of the banks, many of the financial institutions fought at that time, and they continue to try to steadily bring it down and you know cut at its edges and use rulemakings and other kinds of things that are involved that are part of the framework to slow it down, court cases and so forth. So it's sort of a never-ending battle, but importantly, it has really triumphed so far, and I think it will continue to in this particular crisis that we're in. If you could imagine having an economic crisis that's caused by a pandemic and then having a banking crisis on top of that, that would be an absolute disaster. And because the banks have capital and they've been regulated, really during this crisis, they can intermediate credit to the rest of the economy, which is something that they couldn't do in 2008 and 2009 during the financial crisis because they were capital impaired. So not only did they have to help themselves first, but they couldn't help everybody else because they couldn't intermediate credit. Today, they can intermediate credit. They have excellent balance sheets relative to history. And I think that they will be in fine shape over this crisis. And they can work with central banks to help intermediate credit to the real economy, which needs it. And so that's an example of something that where we had a trade-off for societal benefit of resiliency versus efficiency, which would have only helped the banks themselves and their return on capital. But by making capital higher for everyone, we made the system safer and better. And so that's a success in my view. And it's ongoing. We have to continue to work on it, but at any rate, here it is. Something, another financial practice I would suggest is not so good is the practice, and this is very popular with pension funds and institutional asset allocators around the world, is the practice of private equity. And the problem with private equity is it contributes to this idea of maximizing efficiency at the expense of resilience. So a typical public company would be levered maybe 3 times or less. There's some exceptions, but many non-financial companies are levered 3 times debt to EBITDA, which is a standard sort of ratio we use in financial markets, and contribute to a reorganization or even a liquidation of these companies, which then, of course, contributes to unemployment. It contributes to loss of factories, loss of manufacturing, loss of, basically just goes on and on. And that's a practice that I think that we should, with institutional investors, we should try to discourage, because we don't want companies to be living right on the knife's edge. We want companies to have more stability. And so one of the things that I think that we can do about that in terms of a best practice, and something that we already have a sort of a pseudo framework for, is we have this new structure of markets that is popular and is getting more popular, which is ESG, which is environmental, social, and governance practices. And I would propose that in the G part, the governance part, we would put out, we would encourage durability and resilience in companies that investors invest in, i.e. durability and resilience in their supply chains. Now, having multiple supply chains may be less efficient, but it's certainly more resilient. And investors should encourage that, because over a cycle, the company has a much higher likelihood of survival and ability to prosper over a cycle by having resilience. And in addition, investors should be looking at balance sheets and looking at the capital structure of companies and saying, look, is this capital structure in the balance sheet, is it really sustainable? Does it really have resilience? Maybe there should be ratios at which ESG governance aspects, anything over 3 times leverage for non-financial corporates, for instance, should be discouraged. So these are just some brief ideas. But I think that, using ESG as a framework, we could encourage companies to do these things. Whereas, if they were using a weighted average cost of capital or some of the traditional finance or economic theory work in their capital structure, they would be probably more levered. And we need to encourage them to be less levered and more durable, more resilient. So at any rate, so the idea is to triumph over the cult of efficiency and have some other values that we hold dear in society to be inculcated in markets and have more of a balanced market approach. So thank you.
Well, Mike, that was terrifically helpful. And actually that's, you've just brought forth a really important example of recent success that at sort of regulating systems to ensure that they're much more resilient in a crisis. And that's a very encouraging thing that we kind of need today, is actually knowing that human beings are actually quite capable of, even today, even in times, are quite capable of making things better. We're going to go now to Ganesh, and Ganesh is going to sort of talk about what the next international system might look like. And, and we look forward to hearing from Ganesh now. Thank you.
Thanks so much, Barry, and thanks to everyone for joining in and for putting this together. It's terrific to be here, and the conversation's been really exciting so far. I thought what I would do is zoom out a little bit before we think about how to design, or what the components of a design looking forward might look like. And I want to just start with a basic point that's been pretty commonly noted throughout the morning, but I just want to put a fine point on it, which is that resilience is a legal and policy choice. It is something that we can choose to do and that our policy choices allow us to do. It's not something that emerges necessarily from a state of nature or something like that. And context matters quite a bit. We can decide through those policies how much concentration, how much globalization, how much shareholder pressure, how much of any of these things we want to accept in a system. Rana mentioned earlier this challenge that there's often a thought that you either have to move to a fully laissez-faire system or some form of extreme regulation, when in reality, all of our societies and economies have been built somewhere in the middle of those things. And that is the domain of making these kind of policy choices. And I think what we've seen is throughout our history, we've made different policy choices at different times. From the end of World War II through, I would characterize it as about the late 1970s, we had a system of regulated capitalism in the United States and in much of Western Europe. And this system involved keeping the boundaries around the markets, but at the same time also having a lot of space within national governments to provide the kinds of welfare states and benefits that were needed. It was different in different places, but there was a sort of system that understood capitalism had to have some bounds. We then entered what I would call a neoliberal era in which deregulation, privatization, liberalization, and austerity were the dominant modes of economic policy making, at least as a mood or an approach, both on the left and on the right. And I think that has been a second feature of this period. What's striking about that period is that it's really made us in a lot of ways less resilient. And it has caused a variety of problems that we're seeing now. The lack of public action and ability and capacity. We've seen massive inequality in our societies that is magnified in this context, where we see these big disproportionate effects of who's being harmed in this crisis. And I think what we also see, I think since the financial crash especially, but in this moment to an even greater degree, is an understanding that there's a great opportunity for a different kind of era to move beyond what we've had over the last generation. And I think as we think about resilience, I really think there are three categories in which it's worth thinking about how we do resilience. One is the social and political infrastructure in our societies. A second is whether we have resilient markets. And then a third is whether we have resilient international relationships. And as we try to aim for goals of competition and innovation, consumer protection, equal access to goods and services, and resiliency of a system as a whole, I just want to outline three ways of thinking about, especially the market side, because that's where a lot of our focus today has been. And the first is one we've talked a lot about, which is antitrust and competition policy. As we think about the sources, as we think about geographic resilience, as we think about supply chains, thinking about competition and concentration is critical as one angle of that. But a second is regulation. It's not something we've talked as much about here, but throughout our systems, Michael mentioned leverage. Thinking about regulation of leverage is a question. It's a regulatory tool that works in conjunction with other kinds of tools. And we should be thinking about how regulation affects this, whether that is the level of network regulation in infrastructure industries that can guarantee equal access at a controlled price, or the more traditional kinds of regulation that we see on particular behaviors. And then the third is public provision or public options. And that's another area where when we think about basic utilities and essential things that people need, direct public provision is often a better way to have a resilient system than a market, given that there may be market failures or other problems if you're trying to ensure equal access to that good or service throughout the economy. And so with that framework in mind, as we think about those options, antitrust regulation, public provision, as ways to think about addressing particular problems, I think there are a few tactical choices or elements that we need to keep in mind as we're thinking about making those choices. The first is what values we're trying to accomplish. I think a lot of people have talked about how efficiency as a value has really dominated almost all other values in the last generation as we've thought about economic policy making. We need to think broader than efficiency. We need to think about power. We need to think about equality. We need to think about competition and resiliency as part of how we think about economic policy. A second factor is we need to think about the kind of dynamic consequences of the policy choices that we make. Designing policies in specific ways, allowing, for example, as we have significant market concentration over the last generation, has second order effects. An effect of that, for example, is massive concentration means the political context changes in which some companies have extraordinary power and ability to lobby governments, to influence the making of policy down the road to benefit themselves, potentially at the expense of the public good or public resilience. And then a third factor is to what extent we want structural versus technocratic regulation. And I would put myself in the camp of strongly recommending structural reforms rather than technocratic ones. I think Paul's mention earlier gets at this, which is, are you trying to seek out what is the precise nature of the next crisis that might come and solve for that? Or are you trying to design a resilient structure that can weather whatever storm might come? And the latter approach, thinking about the structures, I think is a better way that we should think about policy design than focusing on particular technocratic aims. So with that, thanks everyone for being here and participating, and I'll throw it back to Barry.
Thanks, Ganesh. That was terrific. And just wanted to move on to Doyne Farmer, and then on the other side of this, I have a couple questions from folks out in the world. And so over to you, Doyne. You may be muted.
All right. Supply chains, which I like to think of, I like to call production networks, because supply chains is actually a misnomer. It's not a chain at all, it's a web. And it's not just supplying things, it's producing things. And so we really have to think about that because it's the backbone of the economy. It's the most fundamental thing about the economy. The modern production network allows us all to specialize in ways that Adam Smith could never have dreamed of. And it's a lot of what makes the economic system so powerful. And so, of course, when we have something that really hits it hard, as this crisis is doing, we feel it pretty badly. It's fundamental to the economy in many ways, and I think it's worth keeping in mind. We've been talking a lot about resilience, which I agree is really important. I guess I'm of the view that we're never going to have this perfect. There are fundamental forces, evolutionary forces, that are always pushing us towards increased efficiency, and that, to follow up on a theme that Ganesh said, there's certain ways in which it automatically becomes resilient. If it's getting hit regularly with small shocks, it becomes resilient to those kind of small shocks. And it is doing that all the time. But there's a concept in complex systems called highly optimized tolerance that's now about 20 years old, which is a theory for general complex systems where anytime the complex system has a function, we tend to optimize what we do with it. And we lose tolerance to large, rare shocks as a result, which is why so many things tend to have power laws in these kind of situations, meaning there's heavy tails with extreme events that are going to hit you hard. So we're fighting a fundamental principle of complex systems when we try and make something like the global production network resilient to shocks. And I strongly agree with Ganesh that we need to think about regulation as one of the main ways we can do that. It's not something we can expect it's just going to do by itself. We have to regulate, and the regulation has to have an effect on a global level because there's evolutionary pressure pushing us the other way. Now, but I wanted to say a little bit about a few other properties of supply chains, partly in the spirit of Paul's remarks. Climate change. If we're going to get a grip on climate change, we have to have a deep understanding of the global production network. Why? Because the embedded carbon in anything you buy, how many carbon emissions go into making this iPhone? To know that, I have to know the complete production network of the iPhone, and that production network's at least 7 steps deep. So we have to go all the way back to the mining of tantalum and things like that to understand what's going on. And until we actually can record the global production network, we won't be able to do that. The other thing that we've shown understanding production networks is really important for is economic growth itself. That is, we've shown that the speed of economic growth, all else equal, happens faster with deeper supply chains. Why is that? Because anytime you take a product like my iPhone, anytime there's an improvement in any of the things that are upstream from it in the supply chain, like say tantalum mining, if suddenly tantalum becomes a factor of 2 cheaper, that improvement gets passed on to my iPhone. So the deeper your supply chain, the more possibilities for technological improvement there are along the way. And sure enough, if you go out and look at supply chains and you look at price indices through time, see there's a very clear, unequivocal effect that the deeper the supply chain is, the faster the product tends to improve. So we'd understand a lot more about economic growth if we understood supply chains, particularly because one of the main ways economic growth happens is through the evolution of supply chains themselves. And let me also just say that to understand the global production network, one really needs to think in ecological terms. I could come back and say more about that later. Now, so if we could understand the global production network, we could make vastly better economic models. We'd have a much better understanding of this crisis than we do now. And my team at Oxford is actually busy building models using the best understanding of the global production network we've got. The best understanding we've got is pretty crappy. And that's the limiting factor in our modeling. We're remarkably ignorant at the firm level of what's going on. We know only little pieces of the global production network. We're blocked by confidentiality. People don't let us see what they are actually, what their supply chains are. Now, we need to find ways of unlocking that to get past that confidentiality by somehow getting firms to share the key things that we need to know about their supply chain. Or we need to regulate to just tell them they've got to share. Chile, for example, has made changes in the way the VAT is recorded so that every time there's an economic transaction in Chile, a legal economic transaction, the 2 counterparties are recorded, the product that was transacted is recorded, and the price is recorded. If you have that information, you can reconstruct the whole supply chain of Chile at the level of individual firms and individual products. That's what we need to be able to do globally to really understand this. It also leads us to other problems like, what is the production function? Paul made the point that, if Facebook got knocked out, well, it'd be a minor irritation. But, if our providers of energy got knocked out, we're screwed. And so there's a huge difference between different kinds of production, and the role of different kinds of production as inputs to the other links in the production network. And we don't understand that. We don't understand, there's no good breakdown of questions like, how fundamental is this? Because the way an economist would normally think about a production function would be in terms of the flows of money. And the Facebooks have big flows of money. That doesn't mean they're really essential. We kind of go back to Maslow's hierarchy of needs in something like this crisis. And when you look at the essential industries, they're the ones that are at the bottom of Maslow's pyramid, the things we absolutely have to have. We're actually having to conduct a survey in real time to understand that in order to have a decent model of how big an economic hit the pandemic is going to cause to the global economy, or any national economy for that matter. So if we really want to have better economic models, we have to understand the global production network, because it's the most fundamental thing about the economy. We have hardly any knowledge about it. And we need to be able to make better economic models that we build from the bottom up if we ever really want to understand macro properly. And having data about the global supply network is the fundamental aspect of that. If we had that, we could also do things like stress test its resilience. We could really think about these problems in fine detail. And I think ultimately we're going to have either some commercial incentive for doing that. I have some ideas about ways to actually incentivize companies commercially, or we need regulation. Thank you.
Thank you, Doyne. And actually, that's just a great teeing up of a way to actually tie a couple of things together that we've heard. You're pointing out the fact that it's really hard to see where the risk is. We can't actually identify where the choke points are. We can't identify where the where the location of the shock may emerge from. And earlier today, we heard Yossi Sheffi talk about how, at Starbucks, they know where every single one of their many thousands of farmers are, and they know they are able to track just about every bean through their system. And so the technology exists for us to track every single computer trade. The technology exists for us to track every single component of every product if we choose to do so. As Ganesh said earlier, I mean, the issue is a function of power. So the people that sort of control these systems, they don't want us to see inside. They don't want people to understand where everything is, because that's part of the secret sauce. So there's got to be a balance, and I think that's actually one of our challenges in the years ahead, is actually to figure out ways to keep certain, for us to see where the choke points are, while allowing private corporations to have a certain amount of secrecy in terms of what they're creating and how. One real quick point is we're going to be turning it over to Gabriella again in about 3 minutes. Gabriella will be sort of introducing the final panel, or the final actually sort of wrap-up session. I wanted to bring in one question that was from sort of outside, and this was a person named James Brozovich in Farmington Hills, and he wrote, "This panel has raised so many issues that need to be addressed moving forward. It is obvious to me that some sort of sustained political effort is necessary to do this, and who is going to organize that, and who's going to lead that effort?" And I want to just ask everyone to answer that question in about 2 lines. But before I do that, I'm going to actually quote really quickly Jean Monnet. Jean Monnet was one of the sort of founders of the modern European project. And he was one of the founders of the Coal and Steel Agreement, which is the origins of the European Union. And Jean Monnet at one point wrote, "People only accept change when they're faced with necessity, and only recognize necessity when a crisis is upon them." A crisis is upon us today, and each of you in the 2 lines, like, what institutions are necessary, or what institutions do we already have that will actually help us achieve this? And I'll just in the order that you spoke. So I guess going to Paul first. And remember, just 2 lines.
It has to be driven by the legislature in our societies, and therefore by public pressure on the legislature. And in parliamentary democracies, the executive branch can take it to the legislature, but it has to be the legislature. And my fear would be that the fault lines in your constitution mean that everybody will have incentives to leave it to every other branch.
Okay, great. And Mike, you're actually muted, so before you come on.
Sure, I think that I would agree with Paul. I would also suggest that legislatures and executive branches, for that matter, can be greatly influenced by organizations that help them come up with policies that make sense. And I think with regard for regulation, there's a need for policy that's focused on regulation, and I think that's with our organization, Barry, I think we've been successful with that. I think that your organization's been successful as well. So anyway.
Thank you, Mike. And then Ganesh, you're also muted. So before you give your 2 lines.
Yeah, I agree with both of that. I'll say it in a different way, though, is I think it's going to take everyone. It's going to take organizations. It's going to take individuals who come up with ideas. It's going to take individuals who are out clamoring for change from their elected officials. And it's going to take leaders who are willing to get out there and actually fight for something and lead on these topics. So, this kind of thing doesn't happen because there's someone to rescue us. It happens because we rescue ourselves, and it's going to take all of us to do it.
Great, thank you. And then last, Doyne.
I get to agree with everyone, but I'll just add that I think there are commercial incentives that will change things, because this crisis is showing firms that if they don't understand their supply chains, they're skating on thin ice. And they might understand their immediate supply chains, but they need to go several layers deep. So we need to find a way to provide to firms knowledge about their supply chains in a way that doesn't conflict with their strategic advantage. And I think we can do that.
Well, and I like the idea of ending on the idea that's creating commercial incentives to make this all work. So now we're going to turn it over to Gabriella to manage the wrap up. And thank you. It's good to see you again, Gabriella.